चलिए विल स्टार्ट नाउ, है ना? जोक्स अपार्ट, जोक्स अपार्ट। नहीं नहीं, हम तो मजे ले रहे हैं। चलिए, सो लेट्स कम बैक टू दूसरा। कैसा है कि see, I have also put in the morning, maybe yesterday, one of our senior members, so said we should stop looking at support and resistances on charts. Recession is a time, or when the market is not performing, it's a time when you should build your health and look after health. I think this is a good time after 5:30. हाँ, करेक्ट। चलिए तो शुरू करते हैं। अब मुझे बताइए, दीज आर सम ऑफ दी, दिस इज चैप्टर 3 ऑफ द आरए, है ना? एंड टुडे वी हैव अ limited time we have been allocated. The trainer has been allocated 30 minutes by our esteemed guests here, because they have to visit their जिमिंग सेशन, दे हैव टू अटेंड देयर जिमिंग सेशन। सो ऐसा पहली और उल्टी गंगा मैंने पहली बार देखा है। ट्रेनर को ही बोला जा रहा है कि सर आप 30 मिनट पढ़ा दो, आपका वक्त शुरू होता है अभी। So this is chapter 3 of RA NISM. This is, I think, would look beautiful on your resume, especially MBA. If you are an MBA student, this should be there. Matlab, this is by default. This is a regulatory requirement. A very beautiful book, and the content by NISM. So, in fact, every trainer has to take permission from NISM even to train. So we are all certified to train. Otherwise, you're not allowed to train in the financial market. So today, selling coffee in the market and teaching how to make coffee is easier, but we have so much restriction today as financial trainers. A lot of things we can't speak either on camera or off camera both. मतलब खुद से भी नहीं कई बार ऐसा बात कर सकते. So hence it is essential that you know what are the restrictions that you that have been imposed on you, the restrictions that have been imposed on you as an analyst, as a trainer, as a professor. Even if you're talking doctors as lawyers, if they're talking about stocks, they have to abide by this book, which is very, very important. So this is very important, and ensure that you all of you clear your exams, because when you go for your interview, this will set you apart, है ना? वैसे तो आप सभी अलग हैं, बेशकीमती हैं, कोहिनूर से ज़्यादा महंगे हैं, इसलिए हिंदुस्तान में है ना? कोहिनूर होते तो चोरी हो गए होते, ठीक है? सो वेन एवर पोस्ट इज, वो बकिंगम पैलेस का जब भी वो सेरेमनी का जब ये आता है ना, फोटो या वीडियो आता है, नाउ दी प्रिंस चार्ल्स वेयर्स दैट, हाँ हाँ, कोरोनेशन सेरेमनी का जो भी रहता है, तो वो उसमें आता है। तो उसमें देखिएगा सब इंडियन चोरी का माल है। हीरा जो कोहिनूर आता है ना, आई एम ऑल्सो वन ऑफ दोस्त की, भैया वापस कर दो हमारी चीज लेके, कब तक सर पे रखोगे? चोरी कोई भी चीज पाप है ना? चलिए, तो कम बैक टू दी क्लास। लूट का माल है। सो व्हाट इज फेस वैल्यू, है ना? प्लीज एक्सप्लेन मी व्हाट इज द मीनिंग ऑफ फेस वैल्यू। बोलिए, व्हाट इज द डिफरेंस बिटवीन फेस वैल्यू, बुक वैल्यू एंड मार्केट वैल्यू? एंड easier to explain the other way around if we follow different path, which is market value. बताइए, so what is the other way? हाँ हाँ, ओके। तो क्या यूजुअली क्या सेट होता है इनिशियल वैल्यू? 10 रुपीज। क्यों 10 रुपीज ही क्यों होता है? ये सॉरी, वो क्वेश्चन थोड़ा बदल देते हैं। वो तो मुझे भी नहीं मालूम है कि 10 रुपये क्यों होता है। वैसे कुछ भी, एनी वैल्यू, सॉरी, एनी वैल्यू वी कैन कीप। सो व्हाई, हु सेट्स दिस इनिशियल वैल्यू? क्वेश्चन नंबर 1। कंपनी में हु, दैट इज एग्जैक्टली द क्वेश्चन। कंपनी में हु सेट्स द पोजीशन? The board of directors may be just two people in the board, private limited. CFO, small companies don't have CFOs. It is the chartered accountant who's filing for your paper, who's registering your LLP or a private limited. See, say two people come together, A and B, okay, and they bring in, say, 100,000 INR, which is 1 lakh rupees they bring in, okay. Now there is no business in it. It is day 1. If it is not even day 1, this is maybe day 20, day not 20, sorry. It is T minus 20. The business has not started. The company has not been registered. You are in the process of registering it. Okay, you are 20 days. So if the company starts on the day 0th, we are talking about a procedure which is happening 20 days in advance. है ना? So at this point in time, you contribute from your account you contribute, है ना, 1 lakh rupees. and there is no business at that point in time because the business itself, the company itself is not registered. So how would you book business? In what name would you accept capital, business, etc.? In what name will you accept the check, revenue वगैरह? उस समय क्या होता है? How will the allocation of capital happen? है ना? How will the number of shares? This is the total capital that you are bringing in. But when the profit happens next year, when the company earns profit next year, which is next year 31st March 2027, in what proportion it would be distributed? So that is defined by the number of shares. So they usually assume that 10 rupee is the face value, and hence the number of shares allocated to these partners, which is equal in this case, is 10,000 shares versus 10,000 shares. So on 31st March 2027, if the company makes profit, you know in what proportion to calculate the numbers. Correct? So number of shares is important to calculate the number of shares, because the concept of listing and all has become popular in the last 20 years, and especially post COVID, it has become popular. Think of when you were studying this in 1998, possibly you're not even born. Think of this, you were when this was being taught in an accounting class, in a commerce class in 2000. Think of this when this was being taught in 1970s, and I was even not born. Think of this when was this being taught in 1980s or 2000 or 2005, and you had to distribute capital for which you need the number of shares. That is why this is an assumed number which usually starts from 10. Now, why does it start from 10? Why does it not start from 100? Is something that I have not investigated. Maybe there is a history to it, but usually the face value starts from 10 because you want to calculate the number of shares. This is the capital, correct? The problem is, then why do you need the number of shares? Because you know it is 1 lakh he's contributed, 1 lakh he's contributed. Then when tomorrow when I make the profits, then the number will change. I mean, I know that it is a 1:1 ratio, So 1 lakh A has contributed and 1 lakh B has contributed. So I know the ratio. Why do I need to calculate the number of shares? The problem is next year on 31st March 2027, when the dividend gets declared, when this dividend gets declared, and say these directors or partners, directors for a private limited, partners for a partnership or an LLP, do not withdraw that. So the profit will get added here and get added. Then the capital is 1.10 lakhs. Say the profit is 10,000, and say the profit is this. Total profit is 10,000, 20,000, which gets distributed. So this becomes 1. This capital keeps on changing, especially now. This is equal, easy to understand, because here the relationship is 1:1. The ratio between the partners is 1:1. There are only 2 partners, so it is easy to calculate. But if they are in a private limited company, you can have 50 directors. So if say you have 49 directors, you cannot possibly remember or calculate the number of shares. So you need the number of shares. This is the total profit. Say 20,000 is the total profit, and say everyone holds, maybe 2% of it. So 2 by 49. So knowing the percentage, number of shares is important. Why? Let me sort of reiterate that or rephrase it in case you missed it, because the capital keeps on changing. The capital amount. Why does it keep on changing? Because you have the initial capital, okay, and then initial capital is there, and then you keep on adding profit or loss to it, correct, in form of the not distributed dividend. If you have kept 100% within the company, you add everything. Losses anyways you reduce. Losses cannot be distributed. There is no cash that you distribute when there is a loss. You are not supposed to, by law, you are not supposed to pay dividend when you are a loss maker. That crime has been stopped. So 2007, when I was investigating Lehman, because I don't have any case study from here, we saw in US that Lehman was borrowing from outside world and was distributing dividend. And when I came back and realized, and when we started investigating, we realized that crime has been stopped in the US, and possibly we followed here also. Why? It is as if the person is bankrupt, but he is organizing on a borrowed capital a he's organizing a destination wedding on borrowed capital. It's a crime. You are saying on one hand that I've gone bankrupt, I don't have money to pay back, but at the same time you are paying, or I mean you are organizing a destination wedding, whether it is your money or borrowed capital. So it's a crime. So the capital keeps on changing every year because of the uh, the profits, and this is known as the retained earnings. है ना? The retained earning goes to your reserves. It gets added to the reserves. And when you look at the capital is a summation of the share capital, okay, plus the reserve account. Okay, so your reserve retained earning sits here. So that means every year your capital is fluctuating. However, the number of shares don't change because the profits that you generate is, or the losses that one incurs, is split in the number of shares. So that is why it is essential to the norm. This number remains fixed until unless you buy more shares, or your shares are forfeited, in which case it reduces, or you retire some of the shares, in which case again it is reduced. Otherwise, the number of shares will reduce. That is the reason why the CAs, the chartered accountants who are registering your firm, would like to know how many shares do you own. Have you understood? The share capital keeps changing because of the retained earnings and because you keep adding or keep deducting something, but this remains constant until unless you have infused further capital or retired, taken away some of the shares. You said, I don't want this, give me my money, and I would reduce my holding. Understood? So that is why. So now who started it 10? Can it be 100? I think it is company's choice. We'll have to see the regulation here. I'm not aware of, but I think it could be any amount. It is purely dependent on the company. Why? Because there are so many splits. When you split the stock, then the face value becomes 5. When you split the stock further, it becomes, when you split the stock further, the face value keeps on reducing and reducing. So whenever there is a split, the split does not change the valuation of the company. The only thing happens is you have more portions. Let me just explain it one more time. So when you do a split, what happens is the valuation of the firm, the market value and the book value, both types of valuation remain same. Maybe you had earlier 4 slices of the pizza. Say your friends get crashed at 12 in the night, and you decided to buy, just split the pizza into more slices. Maybe more people came in, so he said, okay, we'll split it into more portions. The number of shares go on increasing, but the overall valuation, the book value and the market value remains the same. It does not change. Split. Why are you doing split? That was from a pizza example, just to give access to more people. Now, from a corporate world, there is no pizza example. This is just for a finance, for non-finance, just to get you interested in the session. Why would you split it? What happens is when the shares go to a certain level, say it becomes 6,000 rupees per piece, it gets to 10,000 rupees per piece. Then what happens is, in such a case, the trading activity reduces, the retailers are not able to buy this. It's expensive. For some people, the 10,000 is the salary for the entire month, so they are not able to buy it. So in that case, they will split into maybe 1/10, then it becomes 600 rupees per share. Has the valuation of the company changed? No. Think of the pizza example. You just split into 2 more slices. The size of the pizza does not change when you're slicing it into many more slices. It's just the value of the slice increases. The overall valuation of the pizza, does it become from a medium pan pizza to a large family size pizza? No, it remains, the size remains. Likewise, the size of the company remains the same. The book value and the market value. What happens is the price of the share, because you split it into 1/10, it has become 600 rupees per share, and you have more number of slices available. Think of this. If I had a facility, for example, on the food trucks in the West, you can go and buy 1 slice. So we would survive on 1 slice and 1 banana. That was our daily capital for the day survival mechanism. So we would buy one big slice. It is a huge slice. Now, if the same food truck decides to cut it into two halves, naturally he will have to sell at a smaller price. If there are two food trucks, and they think that Indians cannot afford even 75 cents or $1, so he would sell maybe a smaller slice. And a smaller slice will sell at a smaller price. Likewise, if you are selling a bigger slice, maybe it is costing $6,000 per share. If you are selling smaller slices, it will cost you only 600 per share. But because everyone in the food truck around is selling the same size of the pizza, the the overall valuation remains the same. Have you understood? Does it bring crystal clarity? है ना? Because then what happens is those are known as, see, arbitrage opportunities. Okay, one is related to what we have seen in the market, and we were not taught in the books, so it took many years to understand. One is a dividend arbitrage. Means what? When dividend is being declared, you go and buy the shares before the record date, so your name appears there, and people think that this is an easy cash flow. Say you bought a share worth 100, after 2-3 days or within a month, maybe whenever is the record date, you get 2 rupees back. So your actual and this is dividend, so your actual investment is 98 rupees. Ideally, the stock price after declaration of the dividend should fall by 2 rupees, because you have removed 2 rupees cash from the bank account of the company and distributed amongst the people. It is like if I were carrying a wallet and I remove 500 bucks or whatever rupees from my wallet, the liquidity in my wallet has gone down. I am 500 rupees less worth. I mean, my worth is less by 500 rupees. Likewise, 2 rupees per share. If you have distributed 500 rupees total from company's bank account, it is less liquid. So its valuation should fall. But then dividend also turns into a speculative activity, and some people think that company is doing good, that's why it is declaring dividend, hence let's go and buy it. So instead of the stock price falling, the stock price actually appreciates. So you gain 2 rupees here, plus you gain on the appreciation side of it. Now likewise, you have an arbitrage on the, people try and make arbitrage on the split side of it. So when the stock price from 6,000 rupees is split and it becomes 600 rupees per share, more and more people start buying. It kicks in a buying behavior, and the stock price from 600 rupees goes to 700 rupees. Once it is split, after the split, effectively that means the pre-split price becomes 7,000 rupees. So you've gained 1,000 rupees. Why would that happen? That would happen because people are just irrational human beings, as Warren Buffett defined. Now, do we have examples around it? IRCT is the best example to study. When the split was announced, I think it was trading anywhere from between 5,000 to 6,000 odd rupees. I have never seen such kind of frenzy in the market to buy IRCTC stocks, especially before the split announcement, and the stock just keeps moving up, up and up, and people are just pumping crazy amount of money, 50 lakhs, 1 crores, because the stock just keeps on moving. And what is the news? It is going for a split does not increase any sort of valuation. This is just irrational behavior there, and as luck would have it, people who buy at the highest price, they also get. So that's about the split. This is known as split arbitrage, but whether it makes sense or not, it is only a trader would know. We have no, when we don't understand that behavior, why would someone do that? Now, what is the book value of the company? Very simple. Can someone tell me what is the book value of the company? That is the net asset, also known as net worth. Net asset is what? Asset minus liabilities. Okay. And where do you see that? So let's go and quickly check that out. If I can exit this quickly and don't save. Let's go to screener here quickly. Any platform that you can simply go. Okay. Chrome to set कर दीजिए. So Okay. So let's identify and let's say I just choose any large company. Why a large cap company? Because none of us would be able to move it. People cannot influence these companies. These are too big to be influenced. And if you look at this one, so this is your book value. These two put together is your book value. है ना? Book value is nothing but what is book value? It is your total assets minus this, which is liability, which includes your current liability plus the long-term liability. What is current liability? Current liability is generated in the process of mostly generated in the process of working capital. So when you are functioning, you generate current liability, current liability, which you have to pay within a 1 year. You have to pay to the vendors, etc., etc. This long-term liability, according to one of the analysts who taught me, who was a great colleague and friend who I would always interact to understand more about it, he used to call it external liability, because this has been financed by banks or maybe in certain cases debentures or bonds. So that made my thought process very clear. Very intelligent guy, could not clear his CA, but he was working for Reuters as an analyst there. And I got an opportunity. We worked a couple of years together when we were working on transactions. And whenever I would have doubt, I would go back and clarify from him. And I think a brilliant mind. And so he used to call it external liability. And I really like that concept, because this is something which is taken from them, from people outside with loan from the banks, either private or public, or it is from in form of debentures or bonds. Why is then this not called internal liability, or why this is not external? Because you generate this in your own course of business. When you're doing the business, you are creating liabilities, and mostly in the form of vendor businesses. Okay? So come back to the point. This is your net worth or the book value. Okay? But please understand, when you add this, this is the total book value. Do you understand this? So total book value, and let's call it TBV. TBV can only be compared to, whether more or less, that is not the point, to the total market capitalization of the company. है ना? Market cap जिसको आप बोलते हो ना, you call this market cap, which comes from the markets. So total book value is nothing but your book value per share multiplied by the number of shares that the company has issued and have been subscribed. Now you know where to find the number of shares we discussed in the very first class. We figured out it from TradingView. What is market capitalization? Market capitalization is nothing but so the market price of the share, market price of the company, so per share market price, okay, multiplied by the total number of shares that have been issued and subscribed. So there is a difference. So when someone calls it BVPS, or if you see the terminology BVPS, it is book value per share. That can be compared to the market value per share. That means the share price that you see on TradingView, that is the share price of one stock. That you can compare only to the book value per share. If you are comparing market capitalization, that is the market cap, then you have to look at this number, which is the total book value or the book value. Have you understood this? Is this point clear? Yes or no? So this reserves includes what all? It includes share premium, because when the business starts functioning and you have a brand value, goodwill, market demand, you don't sell the stock price at the book value. Initially, you may have sold it. For example, the NVIDIA CEO, Jensen Huang or something, the guys who founded NVIDIA said, how much money is there in your pocket? So he said maximum $200, because in the US no one carries a dollar, basically $5-10, and that is also to save your life. That if someone is asking for money at a gunpoint, if you say you don't have gunpoint, we were taught as students that you should have something in your wallet. If he says give money, give that $10 and get rid of it. If you don't give money, then possibly you'll be shot. So that is the training procedure, safety protocol that we had, that have some money. Don't say that I don't have, because they would think that you are lying. So at that point in time, Jensen Huang says, because you will always wonder, only $200? This is, but that's the culture there. They don't keep enough cash. I don't know about now. So $200, Jensen Huang of Nvidia gets 20% at the rate of $200, whatever would have been the per share. So this is the total investment made by him, and this is the total share commitment that he gets. This is most likely the allocation at a book value. There is no business. This conversation is happening when he was working on restaurant or some small company where he gets referred, etc., etc. And I think there were also some story of the restaurant also. So this is possibly not at the market value, but once Nvidia starts functioning and you see the Nvidia of this, today the share prices are selling at share premium, way beyond the face value. So if the face value is 10 rupees and if the share price is say 1100 rupees, the share premium is that you are collecting is 1090 rupees, which reflects in the share premium. This also includes your retained earnings that you have not distributed, and all types of statutory reserves. So I'm talking about the reserves, this reserve. And this is the contribution that has come up initially, and more or less it remains the same if you see. More or less it remains. So this is the capital, and the reserves has many parts: share premium, retained earnings, etc. That all gets added here. So 157 crores is not the capital, just the capital of Maruti Suzuki, which has a sales of about, I think, 80,000 crore, 85,000 crore plus. So that you should understand. Have you understood this? That equity capital on the top is very different from the reserves. This is where the profit retained earnings are added. This is where the share premium issued. So the 10 rupees will go here, and the balance 1090 will go in the share premium. The 10 rupees is the face value. So whatever is the face value will reflect in the share capital, and the balance share premium 1090, in case if it has, the shares have been sold at 1100, whereas the face value was 10. What are you doing with that maximum amount? What accounting will you do so that the extra money that you have collected has to go to share premium account? And you have learned journal entries somewhere or the other. Somewhere you must have studied journal entries. Okay? There was a point in during COVID when I used to teach the impact of journal entries on the stock prices. This was for a commerce college student online I was conducting. It was a beautiful experiment, and students were from a very basic college and they really loved it. Okay. So now look at this. So one is the face value, second is the book value. You already know by this time now. Now let's look at the market price. Another thing that I would like you to do is, just go here and look at this one. So you should also know the relationship between the book value and the price. This is usually how much roughly, if this is 13, this is 3, so what would be the difference? Usually this I have seen it to be around 3.5 to 4x market value to book value. Okay, and what is the face value here? It is already at 5 now. Understood? So how much is the difference? The CA must have, this is obviously after the split, must have started at 10. After the split, this is what it has become. You need to investigate, but look at the difference, look at the difference, and look at the difference. Okay. Now if the management of Maruti Suzuki had decided not to list the shares of the company, and if Maruti was to be sold out lock, stock and barrel, then the discussion and negotiation would start at this price. If I had to sell dispose the entire equity of Maruti Suzuki, but for a listed company, this becomes the reference price. So the management would discuss basis 13,000 rupees. If it is not listed, then it would be discussed basis 3,400. When it goes bankrupt, that's a different scenario altogether, because there is no business in it. So you are just, this is only basis, and this is basically your net asset. And this is basically, this is what net asset. So you can write net worth as, you can simply say it is equity plus reserves. This is your total book value, which is also known as net worth. Okay. Now if there is no equity, say it is wiped off, and what remains in the plant is just plant and machinery. So essentially forget about this one, and what you are looking at what is left in the plant and versus what headache is chasing you, and this is your net asset. So the approach changes from the equity approach to the net asset approach when the company is shutting down, is being liquidated, is already under stress, etc., etc. The point here is that if the company so this is the reason why companies prefer to list. If this company were not listed and people wanted to buy this, they would negotiate at this price, because it has a market price which is many times more than the book value. You will have to negotiate at this price. This is the benefit of listing, why a company should be listed. Have you understood? Yes or no? These finer points you will not find it. In fact, when I was presenting on behalf of BSE, so in 2018 I would go to different parts of Maharashtra and present on behalf of BSE as to why you should list. So I was doing this session in Latur, it was a small city, but very well-known city in Maharashtra, and has a lot of significance on the political landscape of Maharashtra, because ex-CM of Maharashtra, one of the ex-CMs, was from Latur. So Vilas Rao Deshmukh, Ritesh Deshmukh's father's, he was from there, and mass leader. Anyways, so this is about market value. Possibly you've understood. What is replacement value? The cost at which the asset can be replaced. So that is what replacement. So easy to understand. इसमें तो कोई दिक्कत नहीं होनी चाहिए. This is the replacement cost of the asset. Then what is the intrinsic value? So how will you calculate intrinsic value? And this is where you will have to look at Mr. Warren Buffett. So what would you do? You would calculate the DCF, or the present value of all the cash flows that asset is earning, and that is the intrinsic value of the asset. That is why he's against gold, whereas his own central bank, which is American Central Bank, which is the Federal Reserve, is the largest holder of official gold. Officially, we are the largest holder. Maybe our temples hold more than 2 lakh crores. Just one temple. I don't know. We have no number to it. We are the richest in terms of the gold. But if you look at the official gold which the central bank holds, the Federal Reserve holds about 8,000 tons of gold, and we are just half of it, below half mark. Which one? We are just below the, I think it is 3,000 to 4,000. Just check the number. When I present, I remember. So just check now. Wikipedia has a good number on that. So the reason Warren Buffett is against it, इधर देख लो, वो आ जाएगा, वो नंबर आ जाएगा. So the reason, अब ढूंढ लो तुम कर. So the reason Warren Buffett is against it, is against gold investment, is because he does not see any cash flow from gold. Gold is not giving you any cash flow. 1/10 है. Correct. मुझे वही लगा. एक आपने जैसे बोला below 25%. So this is the number that came to mind. So it is not even 25. It is even less. But that's official, and that's with the central bank. Other, वो अलग ही category. That is why we have done a hallmarking. We have introduced a hallmarking. Why the government has introduced a hallmarking is so that you can just do on sitting in the computer, someone at the top can just figure out overall how much gold we have, because someone is wearing 22 carat, someone is wearing 20 carat, maybe 18 carat. It's difficult to find the value of gold that India holds. When everything is hallmarked and there's a GST, that means the tracking is happening. So today we can face and say, America, that you are only at 8,000. We are maybe, one temple holds 2 lakh crores, so just don't talk to us. That is why GST hallmarking is important. That is why GST, because tracking is required. Otherwise, we don't know gold kahan aa raha hai. The maximum gold the maximum black money remains in the form of a bricks, gold bricks. So वही सच्चाई है, मतलब whether we accept or not. So here, so now intrinsic value, and this is globally, it's not about it. So Warren Buffett says कि the intrinsic value of an asset can be calculated by looking at all the cash flows and the terminal value and discounting it backwards to times 0. Gold and precious metals don't give you any cash flows. So that is why he is against the idea of investment in gold, but his own central bank officially is the largest. There is a conflict there. So beware of Firangis. Is my only statement. है ना? कभी कुछ बोलें, कभी कुछ बोलेंगे, अपने हिसाब से बोलते हैं. His logic is correct, but ultimately the currency backing comes from gold. So it has currency has a different currency. You will not be able to pass on for generations. Gold you can pass on. So, anyways, the topic is intrinsic value. So intrinsic value is the sum total of the cash flows till the life, whatever the life is. So that's the intrinsic value. You know. So market value is the price at which the stock or the company trades. You know. That's the market value. This is the trading value or the market value. है ना? Transaction value जो भी आप बोलो जिस पे भी trading होती है. This is the market related price at which the shares trade or the asset trades. This is the trading price in the market, whereas intrinsic value is nothing but the sum total of the cash flows, discounted basis. So it is the DCF of all the cash flow, discounted cash flow. Yes, it's your spreadsheet. No? Now, if the intrinsic value is more than the market value, is this asset class investable? Yes or no? Will you invest in this asset class? And what will you invest? Yes or no? And what if this is reverse? But just let's understand from exam perspective, from textbook perspective, just understand. So if market value is more than its internal worth, that means this price is hyped, overhyped, is expensive, so this is expensive, you will not buy this. So essentially, as an analyst, what you're doing is you are not bothered about other asset classes. You're trying to find an asset class where you can find some worth. The intrinsic value is more than the market value. That is what we are doing as an analyst all the times. ठीक है. So I will मतलब बाद में और ज्ञान नहीं देता हूँ because this is textbook है, so you will get confused in the exams and all. So I should not. But otherwise, I would have quoted George Soros, who I hate the most because they work against countries. You have seen in Bangladesh, that's an act of George Soros. Malaysia openly criticizes George Soros, but that we'll discuss sometime else. And they have been trying to manipulate, and how they manipulate is they try and play around through Instagram with the youth. That's their proven methodology. So they will start inserting videos. So in the morning, if you get up and see negative videos, mostly negative news sells, that anyone knows. So every newspaper across the globe will print negative news. Who got killed, where crime was committed, what auto accidents or these happen. But when you open Instagram, reading negative news and watching a negative news is very different. So you should avoid viewing negative news because it changes. So one Instagram can change the mood of an entire country. It can inflame. So it can start showing you videos at 6:30, 7:30 when you first time you get up and check your Instagrams, and you would realize that the whole sentiment of the country has changed. That is used. It's a tool which is used to, and it is a properly designed. Instagram is not a fun tool. It is a tool which has been designed to control countries. We have seen examples earlier, so be careful of it. चलिए अब market cap देख लेते हैं. Market cap of are categorized as, so what kind of market caps we have? The kind of market caps we have is, one is a blue chip stock, which is also known as a large cap stock. समझे ना? This is also known as a large cap stock. Then you have mid cap stocks, and you have small cap stocks also. I will go to the NSE's page and show you something interesting. First of all, how do you know this is a large cap stock or a blue chip? Top 100 companies are known as blue chip. So first company to the 100th in terms of the valuation of the company, the market. This is mid cap is 1012. This is 1012. बताइए, to the 250th company. This is known as mid value companies, and we are only looking at top 500 companies. For small investors, for say people who are absolute novice, they should only look at Nifty 50, only top 50 companies. As your experience widens then you move to top 100 companies. As you get more matured and more experienced, then you should shift to Nifty 500, and then I think finally Nifty 1000. But you will see that Nifty 1000, there are a lot of stocks which have very high beta, high volatile stocks, and a lot of some of the stocks have very high volatility in it. And this is 251st to the 500th company. Understood? Now let me add something interesting, because this is then purely remains a bookish knowledge which you may have not visited. For every piece of paper, I mean, for every page in this book, you should know which is the site that I have to visit. Then the maturity comes in the market. Otherwise, this is just purely bookish knowledge. So let me just exit this one for a while. You know, for every piece of a finance knowledge, I should have some page I should be able to visit. Then only you can complete your knowledge. Otherwise, it is all. अरे ये कौन सा है? ठीक है? So let me go to Google, and so let me search what is known as बहुत लोगों को नहीं पता है that such sites also exist. It has to uh, you know there are two reasons why you would come here. First of all, you should know your country's indices. That's your primary duty. मुझे लगता है ये सब है ना, जो आपके फंडामेंटल राइट्स एंड ड्यूटीज में ये भी दिस शुड बी इंक्लूडेड. मोर फाइनेंशियल नॉलेज and knowing your indices should be included in your fundamental duties. Which all sectoral indices are there, which are broad based, which are thematic. Because if you have to compare your performance, your own portfolio's performance, you should know which is the right index to follow. And then every index has a fact sheet which people are not. It has a PDF, it has a methodology, calculation methodology, etc. So if you click here, you can go to the index fact sheet, and for each of these indices, they tell you how it was calculated. People are not aware about it. Students are not aware about it. Say for example, I am interested in finding which are the good, say, small caps in India, top 100 small caps. So I will find those top 100 small caps. This is an index. This tells you this is based on the market capitalization. The base value of any index globally starts with 1000. It's a statistical number. That's why it starts with 1000. समझे आप? See, we spoke about standard deviation in the morning. It's a very important thing. Beta is important. Correlation is important. And what are the sectoral representation and the small cap, and which are the stocks? This is not top 100 stocks. This is just by few top constituents by weight. So you've got these banks which you can read on your own. I should not spell out the name for reasons of compliance. I am more interested in this one as to how this was calculated. Okay? And then how the rebalancing is done, which we all know is 6 months, correct? So you should know this. You should at least know, okay, spoke about index, which page of NSE or which page of BSE, which PDF is there, and when was the last it was updated. Then you are matured in the market. Otherwise, you don't know how to hunt information. समझ गए आप? Now let's come back to the indices, because I just want to show you the fact sheet. It has historical data here. It has sectoral data. Beautiful presentations here. I mean, mind-blowing presentations. Say if I choose multi-asset, large cap, small cap, mixed cap, and this is hybrid indices. Select an index, choose the index. Oops. आया नहीं है. चलिए, time frame is maybe let's just submit, but it is not populating only. So what is the limitation? Have you selected something wrong? Let's say fixed income. Is there any index for that? There's a money market index, and select an index which is say 1-day rate index, and let's say some. Let's see what kind of document generates, and you can change the date for 5 years, 10 years also. And these are very beautiful um, uh, infographics kind of a thing which they will generate, and these are all modern, very modern. हाँ जी, आ जाओ। चलिए, बाद में आप देख लेना। What I wanted to show you is check the historical data here. Did we click on the historical data already? Let's say sectoral indices, है ना? Okay, so you have auto, bank, and there are so many that people are not aware of. Say I want to choose something which is rural, consumer durables. This is say this one, and this is which one? Consumer durable, and this is the fact sheet. This is how it has performed. 1 year performance comparison of sector indices. So which sectors have performed in last 1 year? Metal has performed, financials, mid-small financials, and mid-small healthcare has performed. This clearly talks about, this also tells you that a portfolio rebalancing has been done because someone somewhere, or maybe the large funds, or maybe analytical minds had idea that these sectors would do when the economy is slowing, and you are seeing healthcare, smaller IT companies, you are also seeing maybe financial services a little bit, auto a little bit, it depends. And it is mostly, I think, pharma which I am interested in seeing that yes, pharma is doing. So whenever economy is slowing down, pharma does well. So there are a lot of indices which you should be aware of. Chali, come back to it. Now the second topic that they cover is, and why were we talking about? Because we were talking about large cap, small cap, and mid cap. Then the next topic is, okay, you understood the market cap. What is enterprise value? Can someone tell me what is the meaning of enterprise value? Enterprise value, it is equity plus debt minus cash. That is known as the enterprise. This is also known as net debt. Why are you removing debt, cash from the debt? बताइए. Why are you removing debt, cash from the debt? So when you have lying cash, you can easily pay off. And this is what we were seeing in the one of the morning presentation. They said the company had stated that they have 80 crores, and why are they not able to pay a 5 crore of a liability, 3.75 crore of liability? So this means that so this is as good as you can easily pay off. So you are looking at net debt. So this is nothing but your capital structure minus the cash. So this is your debt, this is equity, this is your capital structure minus cash will lead to enterprise value. Enterprise value is also known as firm value. What is the meaning of firm value? It is the total value of the company. It is not just the value of debt. It is not just the value of equity. It is a sum total of debt and equity, and debt on a net basis, that is debt minus cash. Understood? Chaliye, so we are coming towards the end of the chapter. है ना? What is earnings? What is the meaning of historical earnings? So historical is past. Okay. What is the meaning of forward earnings? That is the terminology they use. So historical is past. What is the meaning of forward? It is future, expected ones. Correct? The future. And trailing means last 4 quarters. Last 4 quarters. Okay? And now, what is the meaning of last 4 quarters? Let's go and check. What is the meaning of last 4 quarters? यहाँ दिखाता हूँ. ठीक है. So if I come here, so historical is naturally this one, है ना. Anything on a forward basis, expected basis beyond March 2026 would be forward looking, and these 4 quarters would be known as trailing EPS. These 4 quarters. Why? Because when you are in, say, June, so after this, which quarter will be there? Say you are here, the June quarter is looking at 4 quarters, which is 1, 2, 3, 4. When you are September, the trailing quarters are 1, 2, 3, 4. These 4 quarters. So this is the trailing period. So it is always looking at 4 periods, last 4 quarters. So whenever it says if this is a trailing number and sum total of it is essentially looking at 4 quarters. So where would you find this kind of a trailing quarter? This is where you would find trailing quarter. So you would see that it would say trailing numbers. So it is essentially looking at the last 4 quarters, sum total of it, and presenting it, which is on a rolling basis. It always keeps changing, right? So this is now trailing quarter does not represent you the cyclical nature of the EPS. Meaning what? EPS of the business. So if I am comparing, for example, I will compare March to March, this to this, and this to this. Year end, okay? I would compare rainy season to rainy season to rainy season. Okay? One example, clear cut example here is, notice this one. Construction equipment get impacted. So what we notice in our research is action construction. So you would notice that there is a clear cut dip in the June and pick up in the December. So compare this versus this, compare this versus this, and compare this versus. This is cyclical nature of the business. After the rainy season, the construction equipment picks up. Understood? So this, when you are looking at a trailing business, you are looking at these 4 businesses. You're not bothered about the cyclicity of the business. You're only bothered about the time series of the data. When you are looking at the cyclical nature, maybe you will compare it to June versus June versus June. This is QOQ basis, quarter on quarter basis. Quarterly data on QOQ basis. If you are comparing quarterly data on a YOY basis, that is different. And when you are comparing on a QOQ basis, listen to this very carefully. I know this is getting late for, and all of you have become health conscious after gentlemen's this thing that everyone has to go to the gym. When it is QOQ data, this is important. Suniye, when it is QOQ data, it means this, because it will create confusion if you are not read correctly. When it says, and this is we are still talking about quarterly data, but on QOQ basis. In this case, we are talking about yearly. We are talking about quarterly data, but on YOY basis. This means what? You are comparing March to March to March to March. This talks about the cyclicity. Quarterly data on YOY basis, quarterly data on QOQ basis. Initially, when we used to look at it, it used to create a lot of confusion because the result, you want to copy that, results were quoted at some places on YOY basis and some places on QOQ basis, because someone wanted to talk good about the result, someone wanted to talk bad about the result. So the view, the lens changes. This is quarterly data on QOQ basis, and this is on a quarterly data on a YOY. Have you understood? Yes or no? चलिए, ये समझ गया आप, बहुत समझदार हैं. EBITDA and EBIT, you understand. What is earning per share? जल्दी जल्दी फटाफट. So हाँ, ये देखिए, this is your net profit. Okay, net profit में से preference dividend that leaves you with total earnings, and total earnings divided by the number of shares gives you EPS, and there is a lot of sensitivity of the stock prices to the EPS. This is your EPS. Understood? Clear? Yes or no? What is dividend per share? Which is dividend per share. So whatever dividend has been declared, whatever dividend has been declared, let's go to another this thing and let me show you. So whatever dividend has been declared divided by the number of shares. So if you go to this stock, maybe see, look at this is the dividend percentage. You can calculate from here. So you have 49 odd thousand crore the net profit. Now 81%, 81% of 49,454 into 81% is the dividend that they have distributed. This total dividend, so roughly how much? 80% is a big amount. So 50,000 into 8, so roughly about 40,000. 40,000 odd crores divided by the number of shares is known as DVPS, dividend per DPS, dividend per share. Easy for you to understand. What is price to earning? Price to earnings. So first of all, the formula is market price per share and EPS. So this tells you with regards to the EPS, with regards to the EPS, how expensive is your stock. Say for example, this is 134 rupees, and let's say for example, the stock is trading at 5,000 rupees. So 5,000 rupees is the stock at which price it is trading in the market, 134 rupees your EPS. So how many times it is? If this grows, then eventually this will grow. The stock prices eventually will grow, not in the short run. If EPS drops, the stock prices will also drop. So let's exit of this one and let's go back to the notes. So if the prices move up, in the long run, if there is an EPS rating or the EPS moves up, in the long run, the prices will also move up. If EPS falls, the prices will also fall. So when you have price to earning ratio, if earning goes down, if earning goes down, your PE will get expensive. The stock will become expensive because your earnings are going down. Eventually, the stock will also fall. So every quarter you must watch this as to what is the PE ratio and hence what is the earning, whether the EPS is going up or down, what is the trend in the EPS. It is our fundamental duty to watch for at least top 50 stocks. Otherwise, we should not be called finance students. ठीक है? और आपको एक एक्टिविटी दिया था to watch the EPS of 500, मतलब build a result of the 500 stocks. वो we are still awaiting, है ना? That assignment. Then there is price to sales. Companies which are loss making, in that case, you would look at price to sales because there is no earnings. And there is always a relation. If you don't sell, the company will have no pricing. So for a loss making company, you will focus on price to sales. Okay? Then there is price to book value. Book value we have discussed in detail. Okay? If there is no book value, if there is no net worth, if there is no asset, there will be no manufacturing activity taking place or service activity taking place. If there is no manufacturing activity or service activity taking place because there is nothing on the books, there will be no price. Okay? For companies which are going into liquidation and bankruptcy and which are in trouble, which have issues, the prices tank significantly and the book value is obviously much higher. So this, if the book value per share, this is per share, if the book value per share is higher than the price per share or the price, that means that company is undergoing some problem. And one should only think about such stocks, in my experience, if there is a leader who comes into place. Who are the leaders that we have seen? We have seen Kamath Sahab from ICICI, KV Kamath Sahab. We have seen the Sun Pharma founder. So there are proven leaders. then only maybe Ratan Tata was there, so they can turn around companies, late Ratan Tata. Otherwise, we have not seen. So, price to book value ratio, or P2, price to book ratio less than 1 for a manufacturing company spells trouble. It is talking that this company is into issues. So you should look at price to book ratio. So for price to book ratio is mostly seen for banking stocks. If it is less than 1 for a manufacturing stock, then that means there is some problem in the company. So you should know how to calculate the price to book ratio. That is the exercise. The exercise is given in this book. Then last few concepts. One is the differential voting rights. What is DVR? We have spoken about it. Tata Motors had a normal share, no, an ordinary class shares, and there was Tata Motors DVR. I'm not sure whether it still exists, not heard about it in so many years. And here the voting right was equal to 1/10 of this share. The price, if this was 400 rupees, this would usually trade at about 230 to 250 odd. Why it was trading at a lesser price? Because you had taken away one benefit, one feature, and you know that when you remove a feature, the prices will fall. No, that's how they adjust. Okay. Then few terminologies in the debt market, and I think 4 or 5 terminologies, and then that would help us in closing this. So what are some of the terminologies from the debt market? Face value. What is the face value of the bond? So the bond is nothing but a sum total. If this is, say, trading at 90 rupees, for example, this is the coupon that you're getting. So maybe you are making 10 rupees per year. This is the interest rate, and you discount it. So every year maybe you get. So what is the face value in this stock? In this bond, sorry, we are into the debt part of the chapter 3. What is the face value here? The face value remember in the equity class remains fixed. Likewise, the face value remains fixed. Over there, the assumption was 10 rupees mostly. So what is the face value for in a bonds class? This is a fixed income class. What is the face value? Goli. Huh? In India, it is usually considered to be 100. In the West, when you study, it is considered as 1000. It is also known as par value. How does a bond operate? A bond operates something like this. Okay? Eventually, the prices will converge, if it is trading at a premium, to par value, which is 100. Let's stick to 100 as a convention. That 100 could be equal to 1 lakh rupees essentially. And if it is trading at a discount, it eventually converges to 100. That means in the end you are getting 100. That 100 could be your 1 lakh rupees invested, 10 lakh rupees invested, 1 crore rupees invested. It could be any amount. And this is the formula. This is the coupon that you are getting. So if this is 100 par value, 10% coupon means what? If you have invested 1 lakh rupees every year, how much will you get? You will get 10%. That means 10,000 rupees. So this 10% is known as coupon rate. Now the question is, why is this known as a coupon rate? Because in earlier days, this used to be a physical certificate, with perforated sheets that you can tear and mail it, and that terminology is still used. You could tear that coupon, mail it, and then they would credit the amount in your account. That is why this is still known as coupon. There is no coupon, there is no physical certificate, there are no physical forms, there are no perforated sheets. This you could tear and mail to via the post office. My amount is due, please send me this. Every 6 months. Usually you get the coupon globally every 6 months. So it's a biannual arrangement that you have. You get maturity is the, say if it is a 3-year coupon bond, so the maturity is 3 years. So this is known as the maturity period. What is the principal amount? Principal, this also is known as the principal amount. The par value is also known as the principal amount. That is what you have to return to the investor. The face value, the par value, or the amount that you have borrowed, that is the amount. Yes. What is redemption? When you can sell the bond, redeem it, so when you return it back to the issuer, when you give it back to the issuer, this is known as you return it back to them. So this is known as redemption. After you can do it if there are no clauses, maybe if there is a facility during the maturity period also, that also is possible. Okay, so so if you decide to invest 1 lakh rupees at the rate of 8%, the par value maybe is 100, which is the face value. Okay, so this bond will start paying you how much? Is it 80,000 rupees? 8,000 rupees? 8,000 rupees per year, and which will be discounted at the prevailing rate of interest. This is rate of interest, and say this is a 3-year, say this is a 4-year, split into biannual. So every 6 months you receive payments. Then this will become 8,000 by 2. This will become 8,000 by 2. This will become 8,000 by 2. This is an annual rate, so this will become R by 2. This will become R by 2. This will become R by 2. And this is the 4th payment, which you will get 4,000 rupees here. You will get how much? You will get 4,000 rupees here, plus you will get what you have invested. That by the bond or it's a debenture, you will get your 1 lakh rupees back, and to calculate the value, this is R by 2%. Have you understood this? Yes or no? See, this is 4. So this is 4,000 here, 8,000 by 2. So you are receiving 4,000 every 6 months instead of one payment at the end of the period. So annual, had it been annual, you would have got 4 coupons of 8,000, and at the end of the period, you would have got 1 lakh rupees back. Like an FD, you deposit it, you get interest every year. 4th year, you get your interest plus you get your 1 lakh rupees back, which is the principal amount. In this case, as a global principle, we have accepted that it is not 8,000 rupees. You are getting 4,000 rupees every period. So there are, and it is a 2-year bond. The maturity period of this bond is 2, but the number of payments is 4 actually, because you are getting payments every 6 months. So 4,000 here instead of 8,000, one lump sum, 4,000, 4,000, 4,000, 4,000, plus you are getting your principal back. That is why its name is bond, because the principal is promised, or a debenture, the principal is promised, and you will divide it by 6 monthly rate, the prevailing interest rate. That is why I have not taken interest rate, the full interest rate. I have taken only the half year's annual rate. So if the full year interest rate is 8%, you will discount it at only 4%. Is this clear? Making sense? Or is it the urge to go home which is making you say yes? Okay, last few things. What is holding period return? So if you hold it, say that. So the holding period is, if you hold it for say 3 years, what is the return, what are the cash flows you have got, and what is the money that you have got, and that is your holding period in very simple language. So let's not make it complicated, because people make it very complicated. Okay. This is a very good example. So what are the cash flows here? The cash flows here is he purchases a bond at premium, not at par. So the investor purchases it 100 rupees, 104 bucks. Okay. Then he gets a coupon of 8 rupees. Okay. And the interest rate that he is earning is 7% for a period of 1 year, and then he sells it for 110. So the question is asking what is the holding period return, and this 8 rupees which he earns, he invests for a period of 1 year at the rate of 7%. So this 8 rupees will become how much? This amount after 1 year. Correct? You have invested this much, you have invested this much, you have receiving this much, plus you are receiving this much, and you have to calculate the holding period return. It is very easy. So let's look at the cash flows. What you have got is this one. So you have received this much, correct? Do you agree? Yes or no? Plus you have received this much. Do you agree? Yes or no? Fully. And how much had you invested? 104. This is your holding period. So all your cash flows put together divided by the amount that you had invested, which is your purchasing amount. This gives you holding period return. Okay. What is the current yield? Bolliye, what is the current yield? And how is it different from the coupon rate? And it is something like, it is what? So current yield is, say if you are earning 8% on this and the price is 104, this is your current yield. The coupon rate is 8 rupees you are getting, the par value is 100. This is the coupon rate. It is something like a dividend rate versus dividend yield. The moment you say dividend yield, you have to divide it by the current market price. So if it is dividend yield, for example, what you would do is you would look at how much dividend you have received now. Say you have received maybe 10 rupees, and what is the current price, your acquisition cost of that stock. So if you bought this stock at 104, this becomes your dividend yield. So yield is whenever you divide by the current market price and not by the face value. That's your dividend yield. This is important because people get confused here. What is YTM, yield to maturity? This I'll showcase you from the formula, but what is yield to maturity? Fully. What is yield to maturity? So say you have this bond, which you have bought, okay, and say it has annual payments. No, just for the sake of simplicity and easiness, it has no biannual payments. It has annual payments. Okay. Now understand this. You're getting coupon payment too. Just hold on your breath for 2 minutes, and don't exhale. And in this, at this point in time, it's a 3-year bond. You are also getting your principal back, which you had invested for it. Now, please understand, the rate of interest for each of these years will vary. It's the government G-Sec rate, right? This will vary. If this is a 3-year coupon bond, what rate you will choose? You can choose average, but if you're realistic, you will not choose average. What rates would you choose? Highest? Okay. See, the rate that you would choose is, this is the government yield for 0 to 1 year, for discounting that, rate free, risk free bond. This is 0 to 2 year. What is that government bond which is yield that is being offered on a 2-year bond that you'll use here? And 0 to 3 years, what is the rate being used on a government bond, on a RBI bond for 3 years? Those rates you will use, but you'll realize that these rates are different. So YTM, how much you have made? YTM is the average yield that you have made, or the average rate. See, there are 3 different rates at which you discount. YTM is nothing but the average of this, this and this. This is one single rate at which you discount so that you can use this formula. So you get your current price. You can calculate the current price of the bond using this formula. Current price of the bond is calculated using this price, correct? And say it is trading at, say, maybe 90,000 rupees. Let's just assume, because you invested 100,000, you're getting some coupons, you discount it back, it is trading at 90,000 rupees. Always the price 0 will be less than the maturity value, the terminal value has to be less, correct? Otherwise the formula would not set. Now you have 3 different rates which will apply. Interest rate is a changing phenomenon. Will it hold constant? No. Different periods will be exposed to different interest rates. That people don't understand. And especially when we do the 0 coupon discounting bond, there is a way to calculate the forward rates also. That will discussed differently. That's a different mathematics altogether. When you are discounting at R1, R2, R3, please understand these are three different rates. But if I ask you, call up and ask you, how much did you make on an average basis? So it is an average of R1 plus R2 plus R3, which is nothing but your, this average rate is nothing but your known as yield to maturity. If I hold it till maturity, what is the average rate I have earned? Because you're discounting it at various rates. Again, to reiterate, this R1, where are you going to pick up? So you look at a government GSEC bond 1 year maturity. Here you will look at government bond 2 year maturity, and here you will look at GSEC bond with a 3 year maturity. You will not use G10, GSEC 10 years at all places. No, that's not the correct. It has a different risk. It has a different yield. So 1 year government bond yield should be different from the 2 year, from the 3 year. And because there are inverted yields also, so read about inverted yields. And then I have a lecture on the bonds. Please go and refer that. That is very important. So if there is an inverted yield, here the interest will be very different from this year to this year. So you have to use, for that specific period, you have to figure out what is the GSEC bond quoting and hence apply that in the discounting formula. That is clear. And the average of this, the maths is Y2 maturity. If I hold it till maturity, if I don't hold till maturity, then from YTM you will go to now you understand the logic. If you sold, it is a 3 year bond, but you sold in the first year, then what is my holding period return or holding period yield? Let's call it return. If I don't hold, maybe I sell it in the 1.5th year, so I will switch from YTM to. Now have you understood the logic? This is not explained anywhere in any book as to why the holding period return. Why are we even talking about holding period? Not explained. The logic in here, जब connection पता ही नहीं है, then these are just jargons which are being thrown at you just because you have to clear them. This is stupidity. So the logic has to be there. And for each of the terms that I am writing, if you cannot find a finance page, the page where you can get the quotation, then you are not mature as a finance page. समझे आप? And it has to be some credible source, like an RBI source or NSE site, BSE site or something. So have you understood, yes or no? What is duration? So that is, in a simple language, in an English word, this is the maturity period of the bond. But please understand, the bond is returning you money, is also returning you money. That means you have invested, say, 90 rupees, correct? It is giving you 8 rupees here, and plus at the end you have, this is an outflow for you. This is 90 rupees, is an outflow, so represented by minus 90. This you are getting, this you are getting, this you are getting, and plus you are getting your par value, which is 100. Okay? So you are getting 100 rupees in this case. So the, or maybe you have, if I just take, to make it simple, I have just invested, say, 100 rupees here. So 100 rupees you have put in an FD, which behaves like you're getting 88 rupees here, and then you get your money back. It's like an FD formula, which is also behaves like a bond. Okay. Now, if I give you 100 rupees and take it back after 3 years, my duration is exactly equal to 3 years, and there is no intermittent payment. But here there are intermittent payments at the end of every year. So 27, 28, 29, I'm getting payments from you. So my weighted average duration is much less because I have recovered my amount in a faster, in an earlier, the time frame is less for me. So in that sense, that then the definition of duration changes from the English word duration to a weighted average time in which I have recovered my money. It is going to be less than 3 years if you are paying the coupon. If it's a zero coupon bond, then the duration would be, for a ZCYC bond, zero coupon yield curve bond, would exactly be the duration of the maturity period of the bond. But if you are paying me coupon, the weighted average would be less than 3. Which one? Yes. That is the only thing you receive during the bond. You don't receive anything apart from it. There is only interest that you recover. This is the money that flows from your. हाँ. So आप. Yes, that includes your interest also. And in these periods, you are receiving only interest. There is no other cash flow that you receive. अब कोई बॉन्ड बोले कि यहाँ पर आपको मैं 50 रुपए, आई रिटर्न 50 रुपीज हियर, so that's a different bond, then its duration will be very different. But in normal bonds, you get the maturity value at the end, you get only coupon during it, there are no capital repayments here. But as a treasury head, you can restructure your own coupons. You can pay 50 rupees here, 40 rupees here, and 10 rupees as balance. You can structure that, but usually that does not happen. So now, if my weighted average say comes down from 3 years for a zero coupon bond, because there is no payment, so I only recover all my money. You invest 90 rupees and you recover 100 rupees. That's how a zero coupon behaves. It trades at a discount. It always trades at a discount, means you invest 90 rupees and you get 100 rupees. The gap in the recovery and the investment amount is your interest rate, essentially. In this case, the maturity period is necessarily equivalent to the duration is necessarily equivalent to the maturity period. Then what is the purpose of calculating the duration where there is a weighted average maturity? So duration in that sense also behaves like a sensitivity lever. It measures your sensitivity. So if someone has a duration, some bond has a duration of 3 versus 2.5 versus 1, the bond which has duration of 1 is less sensitive. Yes. It is, then it becomes a percentage number. So for then duration measures that for 1% change in the price, 1% change in the interest rate, what is the change in the price of the bond? The price of the bond in this case, delta price is 3 rupees. This is 2.5 rupees and this is 1 rupees. Listen to it carefully. When I switch from the simple duration calculation, the English duration, to weighted average maturity, what is the purpose of it? The purpose of it is that when duration is 3, that means 1% change in the interest rate in the country, that means their risk-free rate of interest, which is the repo rate. If it changes by 1%, the bond price in this case will change by 3 rupees. In this case, it will change by 2.5 rupees, and in this case, it will change by 1 rupee. Then it measures the sensitivity of the change in the price. So it matures, the concept matures from just being a simple mathematical maturity period to a sensitivity concept. But it has its own lacunas. It does not measure convexity. So then you will have to go from duration to maculus duration, which we will cover in detail when I open the spreadsheet. उस दिन आपका bond पूरा cover हो जाएगा, पूरा concept ही clear हो. Meanwhile, listen to the video which is there in a bonds playlist बना हुआ. Please watch that. It's a very nice video, and I've received some comments from very senior members who are handling a treasury of 45,000 crores. An ex-CFO of a listed company who retired 4 years ago, he said it is very brilliantly made. He may have liked it. Just normally short, तो उसमें कुछ ऐसा खास नहीं, but he liked it, so then I thought, okay, कुछ तो अच्छा ही होगा शायद, he has liked it, so ठीक है. What are the types of bonds? The last concept for the day. I know after this, the bonding towards the gym will increase because you've been waiting. So one is a zero coupon bond. You know that it does not pay any coupons. You buy at a discount and you get the par value. That's it. Par value is 100. That's the face value. It has the highest duration because it does not pay anything in between. Have you understood? Then there are floating rate bonds. So the floating rate bonds are where if the interest rate changes in the country, the interest rate of the floating bond will also go up or down depending on the covenants, depending on the rules and regulations. But here the interest rate changes. It can be linked to the interest rate, or it could be linked to an index rate. It could be linked to the inflation rate. So it could be linked to CPI WPI, which is the inflation index, or it could be linked to interbank rates, माइबोर लाइबोर, देखो आप कैसे कनेक्ट होता है, नॉट अ सिंगल एफर्ट दैट वी पुट हियर गोज फॉर वेस्ट. अभी लाइबर माइबर बोल के निकल जाता, यू नॉट हैव अंडरस्टूड. सो नाउ बिकॉज वी हैव कवर्ड इंटरबैंक रेट्स एंड व्हिच इज योर एफर्ट, आई थिंक. हु डिड दैट? हाँ, you are the best man on the planet right now in terms of the presentation. Only if you skip your gymming sessions. So interbank rate we have already covered. Please watch our video. CPI, WPI, one click picture you clicked which you put on LinkedIn. In the background, if you notice carefully, there is a CPI, WPI discussed. It's a poster. So go and watch that video. So it can be linked to the CPI, WPI, the floating rate bond, or it could be linked to the interbank rate, or it can be linked to the call rates. अब call rates जो है हम लोग when we open one day, what we'll do is we'll simply open RBI's website and surf through it. So we know where are the rates quoted, where are the publications quoted, where are the announcements made, where are the circulars placed. You should have a mental mapping of every important website, including finance ministry, ठीक है, including RBI, including हाँ सेबीज वेबसाइट ऑल्सो, मतलब तो सबसे इम्पोर्टेंट है ना, इंक्लूडिंग MCA, फिर मॉस्पी, मिनिस्ट्री ऑफ स्टैटिस्टिक्स एंड प्लानिंग, बहुत सारे वेबसाइट्स हैं विच वी शुड नो वेयर द हाउ इट इज प्लेस्ड. कॉल रेट जिसपे कि आप ऑप्शंस होते हैं, these are essentially the interest rate which is exchange. We'll go and refer to it. I have never personally gone into depth with it, but with your efforts we will also be looking at. But these are the auction rates which I understand. But more on this shortly because we will have to prepare for this. So floating rate bonds हो गया. Then there are convertible bonds. What are convertible bonds? These get converted into equity. Here comes the complexity of convexity, and this is where simple weighted average maturity time frame, which is duration, will not work. You will have to shift to from Macauley's duration. This is also known as Macauley's duration or something like that. To duration to Macauley's duration to the concept of convexity. You will have to यहाँ पे आपको जाना. Spelling देख लेना आप. In the era of ChatGPT, and while teaching, I can only think about myself, not the spelling. I hope there was a spelling ठीक करने वाला because that is embarrassing at times. ठीक. So duration आपने देख लिया, floating rate bonds देख लिया, convertible bonds देख लिया. हाँ, principal protected bonds होते हैं, है ना. So here the principal is protected, so you don't lose your principal. ठीक है. And why you may lose the principal? थोड़ा इस पर रिसर्च करेंगे, इस पर थोड़ा रिसर्च कीजिए. प्रिंसिपल अमाउंट इज प्रोटेक्टेड फॉर PPNs. अगेन वी विल हैव टू सी, थोड़ा सा डेप्थ में इसमें जाते हैं, है ना. इन्फ्लेशन प्रोटेक्टेड सिक्योरिटीज होते हैं, इसको टिप्स भी बोलते हैं, ट्रेजरी इन्फ्लेशन प्रोटेक्टेड सिक्योरिटीज. सो यू हैव इन्फ्लेशन प्रोटेक्टेड सिक्योरिटीज. That means the rate will reset every time there is an inflation which kicks in. Your interest rate will change, है ना. So in this case, what is happening is very interesting. ये देख लीजिए, last point है. In this case, the principal value changes. It is adjusted to the inflation. It gets inflation indexed. So according to this, what it says, which is very interesting, maybe you invested a capital of, this is your principal amount. If the inflation picks up by 2%, then now you have a capital of 1,02,000. On this, the interest, the coupon would be calculated, which will be a fixed coupon rate, but your principal is indexed, the principal is changing. So your principal is protected, because if the inflation goes up by 2%, your capital, you have lost your capital money, or has lost worth by 2%. So the inflation picks up and then a fixed coupon rate is applied. This is a principal protected, inflation protected securities, also known as TIPS in the West, but very, very important. We have looked at FCCBs, foreign currency bonds. What are foreign currency bonds? बोलिए. Foreign currency bonds we had studied, no? What are foreign currency bonds? So we issued currency, you have issued bonds in a different currency. It is not the home currency. So you are a foreign company essentially to that country where you are raising funds. Itna aap, that makes it simple. So if it is a European company, and a European company raising funds where in a country which is other than Europe, which is this case, raising funds in America. समझे ना आप? So you are raising funds in America. So this is foreign currency bonds. Okay, very simple. What are external bonds, also known as Euro bonds? वैसा ही है, foreign currency bond जैसा ही है ना. So foreign currency bonds are issued by a company in a currency that is different from the currency of its home country. External bonds, also referred as Euro bonds, are bonds issued in a currency that is different from the currency of the country in which it is issued. For example, if a company issues a US dollar denominated bonds in Kuwait, country is Kuwait, but the currency is USD. It's an external bond. So that is how foreign currency bond and external bonds are different. So foreign currency bond क्या हो गया? One more time. This is interesting because ये सब चीजें कई बार हमें पता नहीं होती. And this is external bonds. So in a foreign currency bond, you are issuing in a foreign land, but in the currency of that country. ठीक है? For example, companies in emerging markets like India may prefer to issue bonds in USD or currencies of other economically mature countries as they carry significantly lower interest. है ना? So here in a foreign currency bond, say an Indian company is issuing bonds in the US, but the currency will be यहाँ कुछ अलग ही चीज. Here an Indian company is there, it is issuing bonds in US, but it is issuing is INR terms. That's how this is. थोड़ा सा complicated है, but ठीक है, because practical, if we can ever work on, whenever we get a chance to work on this one, so the currency is Indian. So here Indian ऐसे याद रखो आप, और इधर Indian USD. तो ऐसे याद. Indian is external, foreign is Indian USD. हाँ, correct. हाँ, तो ये foreign company and US. So Indian USD ऐसे आप याद करो and Indian company, Indian currency, Indian company, USD. That is the only way to understand. एक भी याद रह गया तो दूसरा याद हो जाएगा. We just remember one Indian USD, so the other is the opposite side. Last thing of the day, which is perpetual bonds, a never-ending bond. So, you know, there are some bonds which have been there in existence for last 200 years. They never mature. It will never come back. It has a certain risk. I think we were lately reading about it. That these will have the highest maturity, hence the highest sensitivity, hence the highest risk. हाँ, it is. You will. अभी मैं बताता हूँ. Hold on. Just. पहले आप गौर सुनो. 2 points, है ना? Like a शायरी, and then we'll finish this. First of all, this will have the highest duration because there is no maturity. The highest duration means highest sensitivity. So when RBI changes the interest rate, the worst to get impacted will be this bond because it has the highest duration, and highest duration means highest sensitivity. So for every 1% change in the interest rate, these will gain most or suffer most. The relationship between price and yield is inverted, is indirect. So if the interest rate goes up, the prices will fall the most. If the interest rate drops, their prices will gain or increase the highest. That is one. But इसका एक और problem. They are very risky because you have the highest and it is a perpetual bond where the bond will never come, they will never mature, है ना? So we do not have a stated maturity. So these are several banks in India. Listen to this. Several banks in India have issued perpetual bonds to raise additional tier 1 capital as per Basel III norms. This money need not be ever returned to the investor. Okay? The norms specify various criteria that a perpetual bond should meet in order to qualify as AT1, which is tier 1 को इन्होंने नाम दिया है AT1 bond. This is a perpetual bond. तो इसमें रिस्क बहुत ज्यादा हो, रिटर्न्स मिल रहे हैं आपके पास, बहुत पैसा पड़ा आपके पास इसलिए, हाँ इंटरेस्ट पे बॉन्ड मनी विल गेट, ठीक है. सो अभी आएगा आपको समझ में. तो 81 इज अ परपेचुअल बॉन्ड, ठीक है. So let me just point out some difference, some important pointers. 81 perpetual bond do not have fixed maturity date, so it will have the highest duration. They are subordinate to deposits. So in the risk category, they are below deposits, loans from other banks and all other bonds. So they have higher risk category. Though they are in tier 1, but they are subordinate. So when a bank fails, first money will be paid to depositors, then loans from other banks and all other banks, and then money would be returned. So this is kind of a junior bond as we call it, or a subordinate bond, है ना. Tier बनता है, tier 1 capital में भी there are different types of tiers. Who will get the money first when the money has to be returned? So first is a depositor, then comes the loan या borrowed money from the loan from other banks, है ना, loan from other banks, and then comes the 81 bank. This is comes at the last actually, बीच में जो भी होगा. The coupon is non-cumulative. Means what? If any year the bank makes a loss, you forget your coupon. If it is not able to give, then the money is gone. That's non-cumulative. The coupon can be paid only from distributable profits. Very, very important point number 3. If the issuer does not have distributable profits, same like dividend. If there is no dividend, no equity dividend. If there is no profit, no equity dividend. Likewise, if there is no profits here, no coupons. Very, very risky bond. Next year you will get it. If the bank makes money, then next year you will get it. Correct. So this is like a non-cumulative preference share. Preference shares, you have a fixed dividend, but if the company does not make money, no dividend. There are cumulative preference dividends. If you lost your dividend next year, so you get it carried forward calculation wise, and you get it next year. The bonds can be converted into equity by the issuer upon the happening of a pre-specified contingent event. If there is anything contingent which will be mentioned in the policy document or the bond document or the shares, the bond certificate, these bonds, 81 bonds, can be converted into what? Equity. You had gone there for a fixed income. The fixed income does not come because there is no profit. You had gone there for a fixed bond. You thought this is fixed, but if something happens, this can be converted into equity. So you have to be careful of 81 bonds. And here we would end the lecture. Thank you, and just stay on for 2 seconds. So this is, I think we covered the chapter 3. Very interesting. And thank you for your support and cooperation. The way Donald Trump writes in caps lock, thank you for your kind attention! Exclamation mark.